Wait, did you know your life insurance policy could be the key to unlocking immediate cash? That's right. Here's the catch. If you have a policy with a cash value component, you can borrow money from it, potentially giving you access to thousands of dollars when you need it the most. But wait, there's more. Not only can life insurance offer protection, but it can also serve as a low-cost financial option. Oops, but there are some catches you need to be aware of. Let's dive into the fascinating world of borrowing against life insurance, how it works, and how you can calculate the cash value of your policy. When you think of life insurance, you probably picture protection of your loved ones after you're gone. But if you have a permanent life insurance policy, such as whole life or universal life insurance, there's a hidden benefit: the ability to borrow against your policy. So, how does it work? Well, these types of policies build up something called cash value over time. Once you've accumulated enough, you can take out a loan against that cash value. Unlike term life insurance, which doesn't have a cash value component, these permanent policies allow you to tap into the accumulated savings. But let's get specific about how borrowing against life insurance works. Only policies with a cash value component let you take out a loan, and the amount you can borrow is typically up to 90% of that cash value. If your policy has built up $50,000 in cash value, for example, you could borrow up to $45,000. That's real money you can use. And because the loan is from your own policy, you don't need to go through a credit check. Wow, that's a big perk compared to other loans. Plus, the interest rates on these loans tend to be much lower than what you'd get with personal loans or credit cards. Now, here's an interesting twist. You're not required to pay back the loan. Wow, that sounds too good to be true, doesn't it? Well, not exactly. While you don't have to make payments if you don't repay the loan balance and interest will be deducted from your death benefit when you pass away. Your beneficiaries might get less than what you originally planned, so it's crucial to understand this impact. And yes, in most cases, these loans are tax-free as long as the policy remains active and isn't surrendered. So, how do you calculate the cash value of a life insurance policy? This is where things get a little technical. The cash value builds up as a part of your premium payments go into an investment or savings component. In the early years, more of your premium goes towards fees and administrative costs. But as time goes on, more goes into building up the cash value. Over time, some policies may even pay out dividends, which further adds to the cash value. The interest rate provided by the insurance company is also a big factor. For some policies, the cash value grows at a guaranteed rate, while for others, like variable life insurance, the growth depends on how the investment performs. But watch out for surrender fees if you try to access your cash value too early. These fees can take a big chunk out what you'd expect to receive, especially in the first 10 to 15 years of holding the policy. As the policy ages, however, these fees typically decrease. For universal life or variable life insurance policies, the cash value is also affected by the performance of the underlying investments. A good year could boost your cash value, but a bad one could slow its growth. So, how do you actually get an accurate figure of your policy's cash value? You can start by reviewing the statements provided by your insurance company. These typically offer a clear breakdown of how much cash value your policy has accumulated. Some companies also provide online calculators that can give you an estimate based on your premiums, the type of policy you have, and how long you've been paying into it. Alternatively, speaking to your insurance provider directly is a surefire way to get the most up-to-date figure. Now, is borrowing against life insurance worth it? It can be. Imagine you need money for an emergency, a home improvement project, or even college tuition. Having access to funds throughout your life insurance policy can be a great safety net. However, keep in mind that the outstanding balance on your loan will reduce both the cash value and the debt benefit. So, if the loan isn't paid off, the amount your loved ones receive when you pass will be less. Additionally, it is important to regularly request and enforce policy illustration. This will show you how your loan affects your overall policy. You can even ask to see scenarios where you repay the loan, where you borrow additional amounts, or where you let the loan accrue. This way, you can see exactly how your decisions impact your financial future. Lastly, borrowing against life insurance is a powerful financial tool that gives you access to cash when you need it. However, it's essential to understand how the loan affects your policy's cash value and your debt benefit. Carefully monitor your policy, keep an eye on interest rates, and consult your insurance provider or a financial advisor to ensure you're making the best decision for your financial future. With the right approach, borrowing against life insurance can offer flexibility and financial security, but it's not without risks.